Hello, viewers and listeners, and welcome back to the Money Mentor podcast. My name's Chad Williams from Infinity. I'm stepping in this week on behalf of Graham and Glenn. But as always, we have the ever-dependable Dr. Andrew Wilson, Chief Economist of My Housing Market. Doc, it's always a pleasure to see you. I'm very excited for this. How are you doing?
Yeah, I'm good, Chad, and thank you for that ever-reliable tag. I might use that, perhaps named ever-reliable. That's very good. But yes, here we are. We're back again, and we are at the end of autumn. We always sort of talk about where we are in the year, but can you believe this coming Saturday is the 1st of June, which is the first of winter? And it's been a very positive. It is unbelievable, but that's what being alive is all about. You keep moving forward. But it's been a very solid year for housing market activity. We're actually releasing our May housing market report, house price report, house and unit price report on Friday. As we do, we always release on the last day of the month for that month. So we get ahead of just about everybody else, and we have a very reliable and robust data set in terms of house price data. So look out for that one coming through. We will discuss that in some depth in next week's show. So look out for that. But just a heads up, the results again are quite positive. Home prices are continuing to rise, and it's been as I said, a positive start to the year. However, we're all about what's happening in the here and now in terms of the latest data, and of course that's what we aim to do, is to provide all those that particularly decision makers that are wanting to understand what's happening in the market and its prospects in, I guess, near time or real time. And today we've had some very important data released by the ABS, and that's the latest monthly inflation data. And unfortunately, it's not really good news for those that are looking for an interest rate cut soon. And I guess we all like to have an interest rate cut. Well, certainly all our mortgage holders would, but not so much those that have got money in the bank. But we've had another rise in inflation. We'll look at that in some depth. It wasn't really a surprise, Chad, because we've been discussing here the likelihood that April would be another uptick in inflation, because it is very much a hostage to what's happening with the price of oil. And we know the price of oil has been rising over the past 6 months, certainly to April. And although we've had some a little bit of relief over May, we'll look at the latest price of oil in the show today as well. It looks like maybe that's also running out of puff, so not so good. But yes, all the latest data, particularly hot off the press, the inflation data. So let's get going, shall we, Chad?
And looking forward to it, Doc, especially with fresh data sets. This is going to be a real stinger.
Yeah, absolutely. So My Housing Market is my brand. I act as an independent commentator and analyst for the housing market. We also provide a significant in-house data set, but it's not just about house prices per se. It's also about all those other bits and pieces that determine what's happening in our housing market. So that's what we do. We put together all the pieces of the jigsaw puzzle to come up with a robust, as that word again, insight into what is happening. And we are all about the current state and future prospects of housing markets, particularly the current state. That is important. A lot of the insights and the data that we do get in terms of housing market discussions are backward looking, what happened 6 months ago, 12 months ago, which, is obviously not relevant because it's a real movable feast, what's happening in our housing markets and what's happening in our economy. So this is the week ending May the 29th. Yes, we're into June in a couple of days. Winter's here. But of course, the markets, even though the autumn selling season is notionally over because autumn's finished, it does continue on through until basically the end of June. So there's still plenty of activity that's in the marketplace in prospect. And it's really not until we get into July that the market does move into a significant rest period and then starts picking up again in August. So we've still got a month or so to go of activity, and I expect to continue to see prices growing and continuing to see quite vibrant, there's another word, auction market activity, weekend auction market activity. And of course, as usual, we'll look at the latest results from the weekend auction market. So this week in property to Wednesday, May the 29th, which is today, as I've already alluded to, we're going to have a look at the latest inflation data, that is for April. Also, the latest retail sales. those that have, and we've had a big boom in southeast Queensland housing markets over the past couple of years, driven by that migration surge out of COVID lockdowns in Victoria and New South Wales. And let's have a look at how the latest data is tracking for some of those southeast Queensland regions, particularly those investors that are looking to see what sort of returns are currently on offer. I won't go through that in too much depth, Chad, because we'll be here all day. But it is a resource that those can you can refer to just to see what's happening in those southeast Queensland markets, which are gathering a lot of attention at the moment, particularly from investors. And as I mentioned, as usual, we will look at the latest weekend auction results. So let's get started. As I said, not good news with the latest ABS release of the April inflation data. Inflation was up again. Headline inflation rose to 3.6% over April. Now that's up from 3.5% over March. And let's remember that March was up from 3.4% recorded over February. So there's a real trend. Yes, it's only a marginal increase, I guess you could say, but it is an increase in an environment where we are looking for lower inflation, where the Reserve Bank has certainly been promoting lower inflation as the likely ongoing trend for the economy, and it's gone against that. Now it is again April data, and as I've said again, we're nearly into June, so it's a bit backward looking. But the point that was a real concern was that underlying inflation, annual underlying inflation, which is the preferred measure of the Reserve Bank, increased again, similarly to headline, for the third consecutive month, and is now at 4.1%, up from 4%. And we've got to remember the Reserve Bank, focuses on underlying inflation, and its target is to get underlying inflation between 2 and 3%. So not only are we're really sort of well ahead of that, we're also heading in the wrong direction in terms of the trend. So the significant contributors again were housing, and that's been a real problem for the CPI in its breakout period of the last couple of years, up by 4.9% over the year, a little bit better than the previous month, March, which was up 5.2%. But food was up 3.8%, which was higher than the 3.5% annual result over March. But fuel again is what's driving this. The price of fuel was up 7.4% over the year, and that's down a little bit from the 8.1% annual increase over March, but it's still a really big stick. And this is what's obviously contributed to that higher inflation rate. And we predicted this because we knew we can see what the price of oil has done over April, because we get that data in real time, basically. So we can look at that, and then we've got to wait a month or so before we get our inflation data. Now, the point to that, and we'll discuss that in a bit more depth shortly, is that we know oil prices have actually been a little lower over May, so particularly over the latter part of May. So that's given us a bit of hope that maybe the breakout in oil prices is moving the other way, which is good for inflation. However, the last couple of days is just showing perhaps some upward pressure again for the price of oil. But you don't want to be predicting these things because there's a lot of volatile elements that make up that, and we'll talk about that in a sec. But as I said, the underlying inflation is still significantly ahead of the RBA target of 2 to 3%. And the RBA, and we've discussed here, of course, the interest rate decisions. The next interest rate decision will be, I think it's the 18th of June. So we're talking 3 weeks away. It'll be 2 weeks next Tuesday till the next RBA decision on interest rates. Of course, it's a bit different this year. They have some months where they don't have a meeting at all. But the next one's June 18, and they will then be discussing, obviously, these results, and also the federal government's initiative to provide a handout for households for their electricity bill over the next financial year of $300. And the plan there is the Treasury have predicted that will take around about 0.75% off the inflation rate in terms of their modelling. And they're hopeful that, or 0.5% to 0.75%, they're hopeful that will then bring the inflation rate into the target range. So that's the plan. But of course, everything else
Mhm.
sort of has to go right, particularly as we've discussed today, the price of oil, because if that breaks out again, then I don't think it's going to be offset by that the handout from for electricity bills. So, but we wait and see what occurs there. So that's the track of inflation. So this is underlying inflation. As I said, that's the preferred measure of the Reserve Bank. That's what it's focusing its target on, at 2 to 3%. And you can see there, Chad, down, down, down. We had to adjust from the COVID undersupply as we had all those stimulus packages and all the lockdowns created, blockages for supply. We've moved sort of through that now. I think you don't have to wait 2 years to get a couch or a car. Things are a little bit better in terms of those items, those goods, but services are certainly still providing a very sticky environment for getting prices down. Just look at the price of a cup of coffee these days as an example. But you can see there that breakout that we've had in the inflation rate over the past quarter. So the trend is there. You can see it, and it's not very good, sort of reading for those, that have been hopeful that inflation would fall. It's certainly broken away from that reasonably consistent downward trend since the peaks of early last year, which is good. But that was, really realistically never going to be, maintain those terribly high levels that we did have. But now we're still really struggling to get into the target range. We've discussed the outlook for interest rates here over recent weeks, and the Reserve Bank governor has clearly said that they're not going to get spooked by sort of shorter term increases in inflation. They're going to, before they push rates up, they would have to see a significant uptick in inflation going on, a real consolidation of higher inflation. So maybe we're early days into that, but it is still early days. But the Reserve Bank has clearly said that it really needs some very longer term evidence of higher inflation before it considered higher interest rates, which is sort of good news because we don't want higher interest rates, of course, particularly those on a mortgage. Maybe those that have got fixed interest term deposits would like some higher rates, but nonetheless, most of us on a mortgage wouldn't enjoy that. But our inflation rate is certainly ahead of the US at the moment. Our underlying inflation rate, 4.1%, US 3.8. But what's interesting is our interest rates are 1% above the US interest rates. So I think what that tells us in a sense is that even if the US started to cut its rates, there would probably not be necessarily a movement in line with that straight away from Australia, because our rates are still well below the US rates, and that might have some currency implications. So inflation moving the wrong way, Chad. So
and
let's wait and
trending,
see.
Doc.
Yes, I know.
You've got a few months in a row there, so
I know.
that doesn't paint a pretty picture for the next RBA meeting.
No, but they'll say what we've been saying here is that, okay, that's April. They will be meeting in the middle of June. They know they can hopefully, but who knows, have been looking at the movement of the price of oil. They'll know that it's improved over May compared to April, so there'll be some relief there. But again, we're now starting to see early signs, I'm not predicting this, of a reversal in the price of oil. Now, we'll have a look at the relationship between oil and inflation. So you can see the same trend there. See how the inflation rate, which is we've just looked at, you can see that upward trend. But look at the oil trend, the oil price trend. It's exactly the same. Hello, the trend is quite clearly almost identical in terms of higher oil price. A little bit of a lag, of course, because it takes a while for that higher oil prices to be measured in the inflation rate, but there's quite clearly that correlation between higher oil prices and higher inflation. And we saw that last year where we saw that breakout in oil where it moved up to $90 US a barrel, and the Reserve Bank actually increased interest rates over Melbourne Cup Day last year. So there's a clear cause and effect in terms of higher interest rates from higher oil prices driving higher inflation. But you can see there the price of oil averaged $84 US a barrel over April. It's currently at $89 US a barrel. That's the day's spot price. So it's sort of come back up again, 79, but it was tracking around 84, 85. Sorry, 74, 75. But it's now pushing up towards 80 again. So we've got to watch out for that. But there's no doubt of that relationship is quite clear, Chad, in terms of inflation and the price of oil. This isn't rocket science, guys, and it's something we keep an eye on. So watch out for the price at the Bowser petrol, which again is tracking, around about $1.70, $1.80 a litre for petrol at the moment in most capitals, but it was as high as $2.40, a month or so ago. So it is a good forward indicator, as I've said quite clearly, has driven higher inflation again. I mentioned this oil price easing. Well, this is the chart for the price of oil. You can see how it picked up last year, end of last year, and that's when we got that November interest rate increase, and then and then it fell away, and then it picked up again over this year, and we've seen those 3 months in a row of higher inflation. But you can see the trend has moved downwards since April. So we're hoping that's consolidated. But if you look carefully, it's now starting to, looks like it's forming a little bit of a floor. So which way will it go? Will it go find its way down again, or will it start moving up again? You see, one of the problems, I don't want to get too deep into what drives the price of oil, is that part of that lower oil price has certainly been the US has been releasing oil reserves and increasing production into the marketplace. And that has put downward pressure on oil. Now, let's remember, I don't want to get too cynical here, Chad. It is an election year in the US this year. Presidential elections coming up in just around about 5 months' time. And of course, they're very sensitive to the price of oil in the US and to inflation generally. So it wouldn't be good news to the current president, who is struggling a little bit in the polls, to have higher oil prices. So I guess there's plenty of motivation, political motivation, as well, of course, economic motivation, because we want to get inflation down, to get the price of oil down. So as I said, there has been, certainly the US has been increasing production, and they are a big producer of oil, and also releasing some of its strategic reserves into the marketplace. I think that's had an impact over the past month on the price of oil. But unfortunately, OPEC, who are the oil producing cartel, have been quite clear that they want to reduce production and push prices back up again. So they're working in the background to some degree to try to get oil prices up again, no surprise. And I guess they look at, even though when we look at that like $80 US, which it is today, when you go back pre-COVID, that's like double what we were used to before COVID. And then you look at the peak, $124 a barrel. Hello. I think, OPEC are thinking, oh, geez, wouldn't it be nice if we could keep having these really high oil prices? Problem is it fuels inflation, and it impacts economic growth. It reduces the value of currencies, etc. So it's a bit of a cleft stick, but I think that they're still quite interested in pushing the price up, closer to $100 US, which would be really bad news for inflation going forward. But as you can see, that breakout in inflation this year up until April has moderated over May, but just looking like it's thinking about which way it's going to go over June, up or down. So stay tuned. But whatever happens, the May improvement, reasonable improvement, likely will mean a better result when we get the May inflation data out in a month's time. But again, we'll be looking backwards going forward. So some interesting stuff there in terms of inflation. It is very important. We know that. Particularly, we've come from this and still are in this higher inflation environment. It's important for interest rates, and interest rates, of course, are a significant driver of the housing market. in many and varied ways. But another data set we had released this week was retail sales. It's a little bit of a surprise that retail sales were up by 0.1% over the month, still rising retail sales. And they're still up 1.3% over the past year. Now, let's remember, we've had 13 interest rate rises over the past 2 years, and we've still got higher retail sales today than we had a year ago. Yes, we've got higher inflation, which means the value of retail sales is higher. Yes, we've got more migrants, which means people are spending more through migration. But still, we're still tracking at those COVID boom time levels. So, and I think it's interesting that we had that 0.4% fall over March. And those that were hoping that this was another sign that, the economy was starting to cool off and inflation was starting to moderate, haven't been able to justify that with the latest data, which the April data, which is now was up again by 0.1%. And as I said, is still tracking 1.3% higher over the past year, which is actually quite a significant rise year on year. So I'm not sure that those that are cheering along this data and saying, well, this shows you that, retail selling is easing. They can get a lot of sort of value out of it, because I think retail spending is still quite high. Now, we had the ABS, and look, a shout out to the ABS here. I think they're becoming a little bit too subjective in their commentary, because they were like saying, oh, well, it's some more sort of bad news on retail sales, and this shows the trend's falling. Well, yeah, but it's still pretty high, guys. Come on, and girls. And even the inflation data that was released today, they were like, oh, yeah, it was up just a little bit. And yes, it's 2 months in a row. It's been up just a little bit. I'm like, really? It's been up 3 months in a row, gang. I'm not sure this is great news for the Reserve Bank going forward. But as I said, the Commonwealth statistician is supposed to be objective and not be proffering, opinions and subjective insights into the data, regardless of what they're wishing and are hoping and are praying. The data is what the data is, and I think they should leave it to others to be interpreting the data in terms of its economic impact, because they just tend to be, making statements that are, as I said, a little bit subjective. And they were in relation to the retail sales data. They were saying, oh, yeah, well, this is just reinforcing that retail sales are easing. Well, maybe there are other arguments to say that that's not the case. And of course, we remember the ABS statements on when the February retail data came out. They said, because it was a big rise, right? And it was like, hey, this isn't supporting your view that the retail sales are falling away. And they said, apparently it was the Taylor Swift effect on the economy. So yeah, it was the February Taylor Swift economy effect on the economy that drove up retail sales. And of course, the back end of that was we had a fall over March. So like I said, just a shout out to the ABS. Let's just talk about the data, not what it means, please. Yes.
On those retail sales figures, what about something that could possibly give a longer term boost? For example, the electricity price relief that we're going to see coming. Where's that $300 going to go? Could that, support higher retail sales and possibly support inflation?
Well, is it not another stimulus package? It's great. It's going to push inflation down, but it might have the reverse effect. And of course, it's logical that people say, oh, beautiful, I'm going out and spending my $300 on some more cups of coffee or, a shirt or a pair of shoes or whatever it is, which is only going to create more demand and put upward pressure, particularly on services, which have been, driving inflation now that we've sort of rebalanced the goods environment, since our supply lines have improved. With COVID lockdowns, a thing of the past. But you can see when we look at the chart, and you're absolutely 100% right there. That's $300 per household. It's a lot of money coming into the system, it's a saving, and you put it towards your bill, which is great. But it means it's $300 you didn't have to spend out of your pocket anyway. So, but you can see there, obviously, the trend of retail sales has eased. has flattened. It's still higher than a year ago, but you've got to understand, look how much higher we still are compared to the pre-COVID period. We're still tracking 40% higher in the value of retail sales compared to where we were prior to COVID and the stimulus packages. Yes, we've got inflation. Yes, we've got migration, which elevates and inflates those figures to some degree, but not by 40%. So I'm not saying that, it's still a COVID stimulus package boom, but these are still, shows that this is a strong economy and people are out there still spending on retail, even though we've had, 2 years of higher interest rates, 13 increases, we're still out there spending in this economy. So I said that we're going to have a look at what's happening in Southeast Queensland. What about Southeast Queensland, Chad? Hasn't that been a booming market?
Certainly has, Doc.
We've got some insights here for investors on the local Southeast Queensland local government area, so the local LGA. So let's have a look at what's happened with rents in the LGAs in Southeast Queensland. And there's some really incredible results here, particularly when we look at house rents first. Look at the annual growth in Ipswich, Logan, and Moreton Bay for house rents. Obviously, they're more affordable than Brisbane house rents, Brisbane city house rents. So that's all part of that affordability drive. The tenants looking for rental properties they can afford. So they're heading to Ipswich, Logan, Moreton Bay, which are obviously further out on the peripherals, and 20% plus increases in house rents over the past year. And even in the last quarter, rents are continuing to grow, not just on the annual basis, but right across the board, really everywhere, except the Gold Coast, which flattened out. But look at the Gold Coast median rent is $900 now for a house, up 4.7%. Yeah, and even Toowoomba, which has a smaller rental market, up by 20%. And similar results there when we look at units. And of course, some of these suburban LGAs, outer suburban LGAs, don't have a lot of units in the marketplace. So we take that with a grain of salt. But Logan, Moreton Bay, up by over 10% over the past year. But Brisbane unit rents, now it's $650 median a week, up by 12.1%. That's an incredible increase in a market which not that long ago, a lot of the chat was that Brisbane was oversupplied and that, there was a glut of units, all the building that had happened in the valley and down near the river. It was all going to end in tears because they built way too much. Well, all those doomsayers who predicted that, yes, they look silly, but let's face it, they've made looking silly an art form, those that predict those, doom and gloom outcomes. And as I said, 12% increase in Brisbane unit rents over the past year, and strong growth there in Logan and Moreton Bay. But as I said, they don't have the same volume of units in their marketplace. They're more low-rise environments. But look at the Gold Coast units, 11.5% increase in Gold Coast unit rents over the past year. And the median Gold Coast rent for a unit is now $800 a week, which is clearly the highest of all the LGA regions. So still very strong results there on the Gold Coast, particularly for units, which reflects those low vacancy rates. So if we look at the returns, I think this is interesting. These are the returns and the total income. So this looks at the gross yields that we're getting currently in these LGAs based on the latest rents and median house and unit prices. We put those yields together, and they're still over 4% here for houses. And the Gold Coast, I think, is very interesting there. It's still got a yield for houses of 4.6% with a median house price over $1 million, right? So that just shows you the strength of the rent on the Gold Coast at $900 a week, and it's still producing a near 5% gross yield. And when we add the yields, the annual yields to the annual capital growth, so that's the full return, yield and capital growth, some really big numbers there. Brisbane up 28%. So investors in Brisbane are getting a 28% return at the moment, reflecting gross yield and capital growth. And we know Brisbane's just been flying in terms of house price. In fact, and this, of course, is Brisbane City, not the whole Brisbane metro area.
Yes.
But we're looking at a whole metro area median house price for Brisbane, so that includes all the Brisbane LGAs, of $1 million sometime this year, which is quite extraordinary. But look, some big returns there. We see the same up the eastern seaboard of Queensland. And most, if not all, those LGAs, all the way up to Cairns, have had very strong years and are producing very strong returns, inclusive of yields and capital growth for investors. But yeah, Brisbane City, 28% total return there for houses in Brisbane City over the past year. And we've got some quite spectacular returns here. Moreton Bay, okay, 48% total return, but that's again reflecting a small volume of units actually in that marketplace, so we get more volatile returns. But the Gold Coast has returned 27%, which is obviously a larger unit market. In fact, the largest unit market in this snapshot, returning nearly 30%, the Gold Coast, for investors last year, which is inclusive of a 5.6% yield, still a really good yield there, equal with Brisbane, the highest yields there for units on the Gold Coast, and a total return of 26.9%. So those two big unit markets of the Gold Coast and Brisbane are really producing have produced some significant returns for investors over the past 12 months. And as I said, no sign really of slowing down in terms of rents and prices going forward. So I thought that might be interesting, Chad, just to look at what's happening in that pretty vibrant, pretty hot southeast Queensland housing market, which, is starting, that greater Brisbane area is now starting to, or looking to be, more expensive than Melbourne, in the next 12 months. Who would have believed that? So let's have a look at the latest weekend auction results, just to start finishing off our show today. Of course, autumn has finished, the real autumn, but the notional autumn continues, and we had more positive results generally, with higher listing numbers again in Sydney and Melbourne. It's been a very consistent May following the holiday April period, but it's been quite a consistent year so far for our auction markets. This year's auction markets, Chad, really, and we discussed this, have really been characterised by a lot more sellers coming into the market. I mean, a year ago, it was buyers that were coming into the market. They created a mini boom because there was a lot of value around, because the year before, 2022, we saw prices falling. So we saw the markets recover, but it was on the back, as usual, of increased demand from buyers. But this year, it's been sellers that have been the big driving force of the market. And again, we had high numbers of sellers in force for the last autumn weekend of the auction season. Sydney, 785 auctions, 100 more than the weekend before. Very similar clearance rate. Good result for sellers at 73.3%. You can see how much, how fewer the number of auctions are in Sydney compared to a year ago, but the clearance rate is lower. We're going to see some big disparities in a sense comparing to a year ago, because as I said, it was a mini boom through June and into July last year with the market recovering. Melbourne, similar story, 100 more properties going under the hammer. A little bit higher, the clearance rate. Still a good result there for most sellers at 64%, but certainly not as strong as Sydney. Again, significantly higher numbers of auctions compared to a year ago, but there's a big change in the clearance rate compared to a year ago in Melbourne. Brisbane auction numbers down a little bit, but steady in Brisbane. And as we always discuss when we talk about Brisbane auction clearance rates, anything over 50% is really a positive result. It has a different culture, Brisbane, in terms of its auction selling environment. Again, its clearance rates are well below where they were a year ago, where we saw the most extraordinary record clearance rates in Brisbane a year ago, which was the epicenter of one of the hottest markets in Brisbane's history. Adelaide, similar results, down a little bit. Adelaide has just gone off the boil slightly. Still a very hot market, but not as strong as it has been when we were getting 80-90% clearance rates. But still good results there for sellers, and the best results in the country in terms of the clearance rate. And Canberra, we keep talking about Canberra, is just starting to give signs of picking up. after a quiet end to last year. Canberra market really sort of disengaged from the Sydney market, which it usually tracks. And there have been early signs, and we've been predicting, Canberra, is certainly undervalued compared to, it hasn't experienced the growth that most other capitals have. So maybe it's primed for a revival. Good auction clearance rate there, but numbers were lower in Canberra, auction numbers, and around about where it was a year ago. So we're still sort of keeping our eye on that Canberra market to see if it can break out of what's been a significant period in the doldrums. When we look at the trend, Sydney tracking higher than April, that holiday month, and pretty consistent this year in the mid-70s. And just as I said, tracking a little bit below where it was a year ago, which was a super hot market. Melbourne well below where it was a year ago. But look, Melbourne sort of stood up over the last 3 months as well in the mid-60s. We also have said that we think Melbourne's got an opportunity to grow. It has been an underperformer. So we're sort of waiting for signs in Melbourne. And those auction clearance rates still need a little bit of upward pressure on them to start talking about a revival in the market. But the Melbourne rental market is certainly picking up now, and rents are rising quite strongly. So maybe that's the first sign of a revival, a sustained revival in Melbourne. Brisbane just tracking in the mid-50s, again lower than a year ago, which were remarkable results for Brisbane's auction market. And as I mentioned, Adelaide's still very strong, but just not as strong as it was when we were getting those consistent results over 80%. But again, it's been a good, solid, better than solid, a strong start to the year for the Adelaide market. And as I mentioned, Canberra, we've got a bit of problem with the graphic there, but don't worry about that. Just maybe starting to show some signs it's going to lift, but I think there's still some water to go under the bridge before we can call a revival there. But you can see how the Canberra market really dipped away in November last year. So if you want those auction clearance rate results, get onto my LinkedIn channel, where the headline results come out 6:30 of a Saturday, and the full national report is available Sunday mornings on my LinkedIn account, which includes the regional breakdowns for Sydney and Melbourne, as well as the top 10 properties sold under the hammer in all the capitals on the Saturday. I mentioned sellers have been out in force. When we look at the actual number of sales that have been conducted under the hammer this year so far compared to the previous year, these are record numbers for the first 5 months of the year in Sydney and Melbourne. And Brisbane, record numbers of auction sales. So it's not just clearance rates listing when we put it together. So this means that even though our clearance rates have been a little lower, we've had higher listings, which means the actual number of sales has been at record levels. 30% more sales this year in Sydney auction sales compared to the same period last year. Nearly 20% higher in Melbourne, 15% higher in Brisbane, 10% in Adelaide, and Canberra still on struggling a little bit there with auction sales lower than where they were a year ago. There is a QR code if you want to get hold of the latest National Weekend Auction Market Report. That will give you a link to our PDF file. So as usual, we finish off, Chad, just a little bit of an ad here for the My Housing Market Infinity Housing Market Suburb app. There is a QR code to get hold of that and the link. Now we got to have a shout out. It's you got to get a password for this, Chad. So the password
absolutely
will come through Infinity. So if you want to get hold of that app, which is fantastic, you got to get onto Infinity, and they'll give you a password for this app, because this app will give you detailed information on every suburb in Australia in as close to real time as we can do, on a daily basis, updated. And what it does, and here's some screenshots for you, is you can find the price and rent, current price and rent on every suburb in Australia that has data. If it hasn't got any data, it won't be there. But you can filter for price or rent. You can filter for state or regions. Here we've filtered for New South Wales, Sydney, so it's the capital city area. We're looking at Blacktown as our example. We can filter for the type of property, house, townhouse, or unit. Here we're filtering for house. You can also filter here for the number of bedrooms, Chad. Isn't this fabulous? So 5-bedroom Blacktown house currently has a median rent of 1.2545 million. Sorry, that's a median house price, a low price of $990 and a high price of 1.5 million. And there are 9 properties currently for sale. We'll update that screenshot soon. And we can do exactly the same for rent. So the same property there, the same type of property, 5-bedroom house in Blacktown, has a median rent of $600, a higher rent of $700, and just 4 properties for sale, which is no surprise given the shortage of rental stock in Sydney and just about everywhere else. So if you want to know what's happening in the housing market in real time, lots of data there to get a hold of. It's a great thing to have on your phone, because any suburb you're interested in, you can get that key data really, which will tell you exactly what's happening, particularly the amount of properties that are for sale. And if you're a seller, it gives you a sense of what the market's holding at the moment, not just the median price, but also the high price and the low price going forward. Next week, as I mentioned, we will have the May house and unit prices. That will be very interesting to see what's happened over May for house prices. Building approvals, yeah, well, that's been a sad story for a while now, as we try to find more houses to resupply what's a chronically undersupplied housing market. And we've also got the latest GDP data that's coming out. So that's been a little subdued GDP. It's still positive, but it'll be interesting to see, what we have in relation to GDP, and also the latest weekend auction results. So how will the first weekend in winter go in terms of our auction markets, Chad? I know I can tell you're very excited and anticipating what the results will be, but I don't think there'll be a lot of change compared to last week, which is a good thing because our markets are still pretty robust going forward. So if you want to have a look at the report, there's a QR code to download this full report as a PDF file. So that's it for this week, Chad, going forward from My Housing Market and Infinity. And I leave it with you.
Well, Doc, before you run off, I do want to say thank you, but we've also got this week a few viewer and listener questions. You got a minute to answer some of them for your followers?
Absolutely. Yeah, always up for some questions, Chad. So let's go.
Phenomenal. I'm really looking forward to this, Doc. I've seen some of them. And in light of today's presentation, some of them are pretty pertinent. So, first question for you, Doc. What specific commodities, other than oil, have shown significant direct or indirect impact on housing prices and inflation in Australia?
Well, look, how long's a piece of string? But we've said, obviously, inflation is important because it determines where our interest rates are going. Interest rates are very important in Australia's housing market, of course. Probably not as important as the media would think, but it's still obviously important. And the price of oil, we've shown today in some detail, is very important. But Australia is a commodities exporting, resource exporting country. Of course, we used to ride on the back of the sheep. Ride on the back of, you know what I mean, of sheep. But now it's iron ore, not so much coal. But obviously that's a significant part of our economic vibrancy. But I think it's really all about our supply and demand environment, which is driving our housing market, and will continue to drive it because we've just run out of houses going forward. Our economy is strong. We'll always have a strong economy, particularly in relation to other performers. And that is part of because we are a strong exporting country in terms of resources. And we have a small population, a very small population to support with that. So, I guess the big picture, the answer to that is everything, but nothing, if you know what I mean. So, like I said, we're a big exporter. Not just resources, but agricultural products as well. And that helps keep us as being, I think, on a number of measures, Chad, we're the strongest economy in the world, really. And that's like on our wealth per head of population. We're as strong as anyone, if not stronger. Even some of those very small countries that have really tiny populations, we continue to track significantly higher in terms of that per wealth per head of population. So everything but nothing.
Well, it's a brilliant answer, Doc. I think one of the things that stood out to me there was that supply and demand balance that you referred to, and that certainly is going to highlight some of the building approval data that you're bringing us next week.
That's right. Again, we're looking for a revival. The government said that it's hopeful that they'll be building, and it's provided a lot of infrastructure to support state government construction initiatives, but they're hopeful of having 200,000 homes built per year over the next 6 financial years. Just to put that in context, the latest data shows us that we've approved, not completed, approved 150,000 homes over the year to March. So if our target is 200,000 completions, we've only just doing, at the moment, we're doing 150,000 approvals, which aren't all going to turn into completions. And that's, that's a really tough outcome. And the other point to that is those 150,000 approvals, obviously a significant proportion of those are apartments. So they're approvals. So they're not going to turn in anytime soon into a completion, because it takes 2 or 3 years for an approval of an apartment to become a real house, if you know what I mean, somewhere to live in. Yep. So, it is about that imbalance between supply and demand. It's driving our housing markets. But again, and I say this all the time, and I think it's a very important point, is that we're not alone here. There are other similar economies that are suffering the same in Europe, in the US, of undersupply. And it's all about, the struggles that we've had to, build enough homes to meet the demand, the population's demand. And it's the same sort of issues of, red tape, green tape, and, planning restrictions. Any more questions, Chad?
Doc, got a few for you still. There's a question for you on what is your view regarding the Victoria market compared to other states?
Yeah, well, the Victoria market's a big market. I mean, Victoria is a number of markets, right? But I think we're talking about the Melbourne market. But the first point is that Victoria is clearly now the underperformer in terms of state economies. So that can't be a good thing. But the Melbourne market, prices in the Melbourne market are still a couple of percent below where they were 2 years ago. So there is, there is obviously a value proposition in Melbourne. I think eventually that will drive value buyers, and but it is a confidence thing, I think, that's keeping Melbourne back a little bit. It is the higher priced part of the market that has been dragging the chain. There are certainly areas in Melbourne that are still attracting buyers to the west, to the northeast, to the outer east. They're still attracting significant numbers of buyers. But generally, I think that there's just still a bit of a lack of confidence in that Melbourne market. But as we mentioned before, rental market's picking up quite strongly in Melbourne. Rents are rising, vacancy rates are low. Investors are being attracted by, in some suburbs, 8% plus returns, gross yields. So that can create some momentum. But there's no doubt that there's value in that Melbourne market. I also think that we'll start to see a higher proportion of migrants heading into Melbourne as well. But, it's just been a bit of a long-suffering journey for Melbourne. And, I said, but there's no doubt that it's Australia's, it's a very significant part of the, Australian market landscape. Yeah. And, I think it's just waiting to shrug off the chains that's sort of been around it for a couple of years. But there's no doubt that there's very good value in that Melbourne market. And as I said, 8 or 9% returns, gross yields in some of those suburbs, So I think investors are pretty keen in a high interest rate environment or a higher interest rate environment to take advantage of that.
Look, it certainly attracts me to that Melbourne market in particular, Doc. So it's something that I will be keeping an eye on, and I know it's something you'll be keeping an eye on as well. But I'm going to move on to the next question for now, Doc, if you don't mind, just conscious of your time. So the next question from one of your fans is, what are some of the metrics that you use that indicate future price growth is about to occur?
Well, these things happen incrementally. I mean, the point is price growth in a suburb, in a region, is a conglomeration of lots and lots of different little decisions that are happening. Now, we can't really, look into the hearts and minds of every buyer and seller to determine what's going to make them pay more or less. But obviously, the big picture is the performance of the economy, and that's all related to the direction of interest rates. And as we've already discussed, the supply-demand balance, and the thing about prices growth is broadly, and we can only look at it broadly, really. As I said, we can't look at what's happening on the ground per se, per property. We need to sort of aggregate it. The constraints that the banks have on lending, which is a good thing. So if you want to pay more for a property, you've either got to be earning more or you've got to have a lower interest rate, basically. So, you have to, and we don't see big shifts in wage earning capacity or interest rate changes, So it's usually a period of higher price growth follows a period of lower price growth, which is usually in this country generated by problems with confidence, which is what we saw in 2022 when interest rates increased the first time in 10 years. We had, as usual, the scare campaign that was run about doom and gloom. And as usual, they were all wrong, particularly the banks, their forecasts. So prices fell 10% in 2022. And guess what? They increased 10% in 2023. So it was part of that, down and then up environment. And this year we're consolidating, prices still growing, but we're back to more of a normalized environment where we've sort of caught up and we're moving forward. So when we are in that environment, we're really not going to see in an aggregated sort of level prices growth more than about 5% anyway. But what happens to individuals, that's a different story, because you might be motivated to pay more or accept less depending on your particular circumstances. I hope that's clear.
Yep, certainly given me a few things to think about there, Doc. So on the other side of that, sort of preempting price growth, the next question is really, what are some of the indicators that show when a price rally is running out of steam?
Well, we see just the price rallies running out of steam. I think what we look at particularly is, if we're looking at like a real-time environment, is what's happening in the weekend auction markets. I think they give us sort of a weekend by weekend snapshot of what's happening. Now, not all capital cities have auction market activity, robust auction market activity. It's basically, Melbourne, Sydney, Adelaide, Brisbane, and Canberra. But they still reflect to some degree what's happening nationally. But those auction clearance rates, auction volumes, and then we compare it with the previous weekend and the same period last year, and that can tell us, that markets are starting to ease. We've seen that in Melbourne with its clearance rates falling away over the past 9 months or so, and Sydney holding up. So I think those weekend auction clearance rates are a very good forward indicator of how markets are travelling, and that just means there's more or less demand happening. But you can, as I said, to track that in terms of the number of listings as well as the number of clearances, the clearance rate, and also the number of sales, which we've sort of discussed today, which puts it all together, as one end game. So even though our clearance rates have been lower, our sales have been higher this year, auction sales.
Yeah, it's a brilliant
Any more
real-time
questions?
data set. There is one last one for you, Doc, and we're going to end on a bit of a long-winded one, given a bit of context here, though. The question is, with the recent announcement of Kensington banks in Victoria zoned as flood-prone in the new modelling, it's expected to push down prices in that area. Queensland and New South Wales have areas with the same issue. How can investors reduce those sorts of losses when councils are pushing to build more homes and town planning are laxing their due diligence?
Well, look, it's all about choice and affordability, isn't it? And when we don't have enough houses to go around, you start having to make choices and contingencies. And it is about the level of demand. And if there are issues to do with, as you said, outside forces that are obviously going to have to take some remedial action. It just means that prices, won't be as high where those don't have to be taken. But people will make a choice based on the fact that we don't have enough housing anyway. But our problem really, and not just our problem, but a problem globally, particularly in Western economies, is that we've underbuilt, and a lot of that underbuilding has occurred because of ideological views of the housing market, which have proven to create these terrible inconsistencies and imbalances in housing. And it's not just Australia. It's most European countries, the UK and the US are all suffering from problems with providing, and those that are there, their role is to provide the policies to provide housing, have failed the populace to do this. Now it's almost impossible to remedy this, but the one remedy that there is for those that are suffering high rents and high prices is at the ballot box. And let me tell you, they're not a happy bunch in a lot of these jurisdictions, and they're voting, to show that they haven't been happy with what's been provided in housing markets for the best part of a generation. So, unfortunately, it is about ideology meeting reality. And the reality is we just are so undersupplied in housing in this country that it's going to be very tough for potential renters and first home buyers for quite some time, if not forever, in this country. So hopefully not. But I'm not confident that we still have governments that are prepared to provide realistic solutions to the problem. So that's a long-winded answer to a long-winded question.
Yeah, difficult to nail down one particular answer there. But Doc, that was the last question. I think at this point, I just need to thank you for your time.
Oh, my pleasure. Always good. And see you all next week.
Looking forward to it, Doc, and looking forward to the weekend auction results on your LinkedIn page as well.
Yes. Good one.
Fantastic. Thanks, winter. Doc. We'll see you next week.
See ya.